I am currently in the process of trying to help a family member with their finances, but any mention of investing is met with great reluctance, which is rather apt, given the name of this channel. My girlfriend also has similar reservations and often expresses the sentiment that investing is just gambling for rich people, a sentiment to which my family member agrees with, and I'm just left pulling my hair out, my hair which grows ever longer, as you can probably tell, in this seemingly never-ending lockdown. However, my frustrations are misplaced and their doubts are perfectly justified. So I thought instead of just sitting there and getting frustrated, why not try to make the argument more reasoned and more eloquently in a video which I can send to them and which hopefully might be of some benefit to some of you as well. If you enjoyed today's video, please do hit the like button, feel free to leave a comment, subscribe, turn on notifications, and maybe even send the link to a friend or share it on social media if you think it might be of benefit to someone else as well. Now, I'll start off by very quickly reading out a couple of definitions of the relevant terms, dictionary definitions, just as a useful starting point, and I've made a note of those here. So, the dictionary definition of gambling is simply to play games of chance for money. Meanwhile, the dictionary definition of investing is to put money into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. And as a bonus, I have also included another definition of investing. This isn't the dictionary definition, this is Ben Graham's definition. Here's what he said. He said, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Now, there is quite a big difference between those two different definitions of investing, which I think is key to this discussion. But firstly, the fact that gambling is defined as a game of chance means that when you're gambling, you have almost no impact upon the outcome. So the risk is high because you can't dictate the outcome. So by that definition, even something like poker, you could say isn't gambling, because a poker player, there is some skill involved. They do have some impact upon the risk that they take. And in different countries and territories, you'll find that poker is sometimes defined as being a game of chance and sometimes as a game of skill. But that's just a little aside. More crucially is that additional clause between Ben Graham's definition of investing and the dictionary definition, which I'll repeat quickly, is upon thorough analysis, promises safety of principal and a satisfactory return. Now, just so you know, Ben Graham was an investor himself and a professor and an author. And together with a man called David Dodd, who'd lost almost all of his fortune in the Wall Street crash, together they came up with a more conservative style of investing based purely on fundamentals, and they coined that value investing. This is the same method of investing, with one or two notable exceptions, that has made Warren Buffett one of the richest people in the world. Now, value investing just involves buying securities that you believe to be undervalued, following thorough analysis of the company's fundamentals. Warren Buffett has achieved a 17+% annual rate of return on average since 1985, and much higher returns than that prior to 1985 when he had less money. So when you're value investing, it's easier to achieve higher returns with a smaller amount of money, especially when you reach the levels of that Warren Buffett invests now. But that's not something you need to know about for the purposes of this. Basically, what we can say is, with even taking the low figure of 17% annual rate of return, that's not a return that a roulette player can achieve. If you play roulette, you might get a big win on a spin or even in one evening, but on a consistent basis, you're not going to be able to average any kind of positive rate of return. And what's more, something like roulette, in terms of that type of gambling, isn't just like flipping a coin where there's a 50-50 chance, since a casino is actually rigged against you. So eventually, over a long enough period of time, a roulette player will always lose money. We should say then that we can conclude that value investing isn't just gambling. The proof is there. When done well, when thorough analysis is made of companies, it's completely different to gambling. However, it would be foolish and downright dishonest to suggest that the majority of financial activity represents anything like value investing. So what about the bulk of stock market transactions? Are they just gambling? One of the most popular methods of investing, far more popular than value investing, and particularly popular among retail investors, is either indexing or putting your money into a mutual fund. So there's ETFs and mutual funds. Basically, an ETF is just a tracker, so something like the S&P 500 tracks the 500 largest companies in the United States, or you can get ETFs for all sorts, so maybe the 1,000 largest companies in East Asia, or you can even do a certain region excluding a country, or just even a more obscure economy, the Bolivian ETF, if for some reason that took your fancy. Meanwhile, a mutual fund is actively managed, so it doesn't just track these certain number of companies in a certain region. It's managed by either a single investment manager, fund manager, or a collection of people who do research and have their opinions on what companies are going to do well. And basically, it's a mutual fund because a number of people put money into it, and then they invest that money, and depending on how their investments do, essentially what you're doing is you're trusting your money with someone who you deem to have the time and expertise that you don't. It's the case that most ETFs, good ETFs anyway, or broad ETFs, whether that's an all-world fund or a tracker for, say, the US market, that will tend to outperform the majority of fund managers. So ETFs tend to be a better investment than mutual funds. And also, because no one is actively doing anything on an ETF, it's simply tracking a certain market, they also tend to have very low fees. So you can even get some now 0%, I believe, ETFs with some brokerages, even at a very expensive charge on an ETF would be something like 0.7%. Meanwhile, you'll get mutual funds with much higher percentages, typically over 1%, sometimes as high as 3 or 4% even, which obviously that is eating away at your gains. So oftentimes, even if a mutual fund were to outperform an ETF, once fees are taken into account, it might not. But anyway, again, that's just an aside. Let's take ETFs as an example, since they tend to outperform mutual funds. With an ETF, you cannot be said to be value investing because you are not doing thorough analysis of the fundamentals of companies. You are just buying a big basket of stocks, a big broad range of companies. So you're not value investing, but what you do have on your side is historical precedent. So over time, it's no secret that the stock market tends to go up over a long period of time at least. This doesn't happen in a straight line. It's choppy. It's up and down. So analysis of the last 200 years of the US stock market shows that in 70% of years, the stock market goes up, and in 30%, it goes down. Now, sometimes it goes up by a lot, sometimes it goes down by a lot, and sometimes it stays relatively flat. So, but broadly speaking, over a long period of time, the average market return on an annual basis averages out around 7 to 8%. Now, that is obviously a much more productive rate of return than you're likely to get going to a casino. If you went to a casino every night for 200 years and just play roulette, you would be the luckiest person in the world to get a 7 to 8% return on an annual basis. However, many retail and institutional investors neither index nor value invest, but day trade and speculate. Now, Graham and Dodd would say that these people are not investors at all, and they draw a big line, a big difference between the two, and say that that's simply not investing, that's just speculating. They're two completely different things. However, to many people who day trade and speculate, in their own minds, they are investors. So I think that's worth talking about just a little bit. So when people buy, say, penny stocks or cryptocurrencies, and they buy them with the sole intention of thinking, well, I'll buy this, and hopefully someone else will buy it off me for more. That's all that they think. There's zero analysis of what is this fundamentally worth. What are the fundamentals of this? Is it it's not they're not thinking that it's going to produce anything for them. They're just purely hoping that someone else will come along and pay them more for it than they paid for it. Now, to my mind, this is gambling. If that is your only idea of investing, if that's what you consider to be investing, then I would agree with my family member and with my girlfriend. That's just gambling, basically. And it's worth noting that roughly 80% of all day traders lose money. And so, I mean, that might be a slightly better rate of return than casino goers, but not by much. Now, it's also true, I mean, I mentioned penny stocks and cryptocurrencies. I'm not suggesting that penny stocks and cryptocurrencies are a poor investment necessarily. It's just the case that if you haven't done thorough analysis and you don't know why you're buying a cryptocurrency or a penny stock, that's when it's a bad investment. By the same token, even a fantastic investment can become a bad investment and can become effectively gambling without thorough research, without proper due diligence and an understanding of the fundamentals. So take Apple for example, which is obviously an enormous, hugely profitable company. If you were to buy Apple stock at $100, for example, and then that stock, but you bought it at $100 because maybe a friend said, Apple stock's going up, it's a good investment. Now, let's say the stock is worth $200 and you've paid $100 for it because someone gave you a tip. Now, you've made a very good investment, but you don't know why. So that stock the next week falls to $75. What happens? Most people, they panic and they think, oh no, I've made, that tip was wrong. Clearly it's it's not going up, it's going down. They panic and they sell. Maybe a year later, the stock's at $200, $300. But even though it was a good investment at $100, because the individual involved didn't know why they'd invested in it, didn't know what it was truly worth to start off with, so they still didn't know what it was truly worth when it fell. What they really should have done if they understood their investment was when they bought it at 100, knowing it was worth 200, when it fell to 75, they should have been buying more if they understood their investment. But that's just an example of how even a wise investment can become a poor investment if you don't know what you're doing. So all forms of investing carry a certain degree of risk. If you're a value investor, even a very good one, and you thoroughly analyze a stock and you see that it's undervalued and you buy it, you think, perfect, I've got a big margin of safety. Well, it's not unfathomable that overnight the fundamentals could completely change. A competitor comes along and blows you out of the water. There you go. Suddenly, what initially seemed to be a brilliant investment no longer is. That can happen. Even an ETF, broad market investor, even though historically, over a long period of time, would have always done well, we have an economic system that is based on never-ending growth. Say that comes to an end. We no longer have growth over a long period of time. Well, then suddenly that's investment has no longer produced money for you. So every form of investing carries some degree of risk. So if your definition of gambling is simply there is any amount of risk whatsoever, well then even to you a Vanguard 20% equity, which is one of sort of the lowest risk funds that you could possibly buy, even that to you would be gambling because there is some risk. Your investment could go down. But by that logic, by that definition, what form of asset allocation, where could you possibly put your money and have no risk? So you could buy a bond. With a bond, you get a sticker price, you get a guaranteed rate of return. But at this moment in time, you're likely to get either 0%, so no return, or a negative interest rate. So you'd actually you basically pay someone to hold your money, and they give you less money back after a stated period of time. So in that sense, you have removed the risk. You know exactly what's going to happen. You know exactly what you're going to get back. It's just that what you're going to get back is appalling. So that is one option, I suppose, in terms of actually removing risk. But even then, it doesn't fully remove the risk, as I'm about to come to. But alternatively, you might think property. Well, property just has exactly the same risks. The value of commercial or residential property and real estate can go down in much the same way as stocks and shares can, even a broad range of stocks and shares, exactly the same. And the same goes for investments like classic cars or antiques, watches, any collectibles, anything like that. exactly the same is true of that. A lot of people think, well, what about cash then? Surely that is the safest possible investment. Well, not really. So you might think, well, if I put £1,000 in a bank account, if I come back in a year, 10 years, 50 years, there's still going to be £1,000 in that bank account. And that's true. But the actual spending power of that £1,000, obviously with inflation, decreases. So in many respects, keeping your money in cash is the worst possible investment because, like going to the casino, the odds are actually stacked against you. So central banks in most major developed economies aim for around 2% inflation a year. So your money left in the bank with no interest is essentially every year its spending power is decreased by 2%. Now, even if you were to have a 1% interest rate, say in just a savings account or something like that, which is very generous at this moment in time, even though the numerical value of your money will increase by 1% every year, in real terms, if there was a 2% inflation every year, it would still be, your spending power would be decreasing overall by 1% every year. So that isn't a great investment. And to give a working example, say in the year 1990, you put £10,000 in a bank account, locked it away, never thought about it. Okay, you come back now in the year 2021, that £10,000 is now worth less than £5,000 would have been worth at the time. So the spending power of your money has decreased by more than half. Alternatively, if you'd put that £10,000 into an ETF that had achieved an average market return of 7.5%, well then, because of compound interest, that £10,000 would be worth around £87,500. So you can see the difference between the two. So yes, all investments carry some risk, but it's not necessarily gambling, so long as you do your due diligence and understand why you hold the positions that you do, whether that's an index fund or a big blue chip company or even a tiny little startup. The same goes for all forms of asset allocations. It's just a question of weighing up all the possible options, doing thorough research, and determining which is best for you with the full wisdom of that knowledge. Now, of course, in the event that, say, interest rates were to skyrocket to 15% or even 5%, suddenly the attractiveness of investing, in terms of investing in the stock market, is completely shifts, because you can say, well, I'd rather have that guaranteed 5% than the risk, but the likely outcome of 7 or 8%. Now, that would be a fair judgment call. But at this moment in time, that simply isn't an option for you. It just isn't the case. So hopefully that has cleared up some confusion, some misconceptions within my own family, and fingers crossed beyond as well. As I say, First and foremost, if you have any questions, leave them in the comments and I'll try to address them either directly to you in the comments or in a future video, as is always the case. But yeah, thank you very much for watching. Please do hit the like button, comment, subscribe, notifications, all the rest of it. And like I say, share it on social media or with a friend if you think they might enjoy it or benefit from it. It is much appreciated, especially with the channel being in this early stages. And I should say, even though it happened a couple of weeks back now, the channel has hit 1,000 subscribers, and a huge thank you to all 1,000 of you, or whatever that number might be when this video comes out. Again, it's greatly appreciated.